Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the trading week ending June 9th, 2017. What an interesting week. What I've got on the screen here is a whole lot of support price levels, a couple of Fibonacci's thrown in, and some longer term price support levels. But before I jump into the chart itself, just so that you guys understand, the markets, we've gotten through a number of things this week, but we've seen some profit taking in technology. We're seeing some of the money come out of tech and into some of the lagging sectors for the year. One of them would be energy, which was one of the best performers on Friday, along with the banking sector. But we've seen the so-called FAANG stocks and plus Microsoft, that would be Facebook and Apple, Amazon, Google, they account for almost 56-57% of the returns on the S&P this year, and they make up just slightly under half of the value of this Nasdaq 100 futures, which is why Friday we saw a really huge downdraft in Nasdaq futures. In fact, our members, we've been stalking this thing out for a while, and we finally got a nice payday on it this past Friday. It was over 1.8%. I think just on that day alone, yesterday, they gave up a combined value of about $97 billion. Now, do I think that downdraft to continue? I do believe that they're still overvalued a little bit from a relative performance basis. I think longer term, they're a good place to have some money, but I think chasing at these levels just does not make sense to me. We've also seen that central banks globally have pumped about $1.5 trillion of liquidity into their respective marketplace. Meanwhile, here in the U.S., the Feds, which meet next Tuesday and Wednesday, are looking at reducing liquidity in our market or taking our balance sheet down, and there's a 90% chance plus 95% chance that they're going to hike the rates this next Wednesday. But all markets are going to be focused on exactly how are they going to take money out of our balance sheet, $4.5 trillion, and how many more rate hikes. Is Yellen going to be more dovish? Is she going to be more hawkish? I wouldn't use the word more dovish. She's always been dovish, but let's kind of see how that thing plays out. Meanwhile, S&P multiples are up around 18.8 times earnings. Now, just a few weeks ago, they were about 18.1 right after we started finishing the bulk of the Q1 earnings, which, grew about 15%. So corporate earnings are strong. Interest rates are very low. Inflation is low. It's a fairly Goldilocks type of scenario. But for our members, we shut down another one of our what we call our Superfly trades. And again, another successful trade. Although I will admit Friday was a hairy day to shut it down, we were able to make profits, but it certainly was a fun day because the markets made all-time highs and then proceeded to sell off, and it was volatility popped a pretty good little bit from the lows. But in the scheme of things, volatility is still low. So having said all of that, let's go take a look at the charts here. What I've got, as I said on the screen, is the S&P 500 E-mini futures. I've got a lot of things here on the graph. Or this chart rather, but let me just take it off the screen and kind of clear it up for you. You can see that we've got this pattern that has worked, it's working its way through, which is an Elliott wave 3-4-5 pattern. And the three leg traditionally in an Elliott wave type wave structure is the bigger wave. Then you have a profit taking wave and what I'd call buy the dip kind of thing, right? We were in that buy the dip. Almost like a bull flag. We broke out in this gap right here, which was when Macron won. We came back and did a little bit of a retest, when we had that pretty good little pullback on May 20th. The Nasdaq surprisingly fell about 1.8% then as well. But we hit this solid support area here. It's a key Fibonacci extension off prior pivot highs and lows, and now we've come up and we formed an Elliott wave 5. Now, the way we work and use our divergences and our charts, this to me, what we would typically call, it is a bearish divergence, but we call it our poor man's bed, okay? Bearish divergence, and there are a number of factors that go into it. I'm not going to do it here for our members, we'll go through a little bit more detail on Sunday night on our weekly market watch for the upcoming week. But you can see here that it does suggest that we're going to be in a similar scenario that we were in right here. Kind of a buy the dip kind of thing. Now we got a couple of existential threats coming up. And when I say threats, I just mean a chance to really move the markets a little bit more. One of it can be Yellen on Wednesday. I mean, we've got that. That's going to be the big thing. Most markets, most analysts expect a rate hike. I expect a rate hike. I think everybody does. But everybody's going to have eyes and ears glued, mostly ears, to her 2:30 p.m. New York City time press conference on Wednesday the 14th. So everybody wants to know how that is going to play itself out. So that's going to be a very, very important day. We also get interest rate decisions this week out of the ECB, or Bank of England rather. We get them on Thursday, and then Friday we get them out of Bank of Japan. So we got a couple of things that can bounce currencies around a little bit this week. But I do believe we're still in a buy the dip mode, even with the bearish divergence here. You can see how the markets are kind of playing themselves. Those blue lines over on the left-hand side of the screen is volume over price. And you can see right here, most of the volume over price is centered around 2380 down to 2340, about a 40-point area here. And again, I would not be surprised at all to see price come back down in here. This is when buyers and sellers have just been fighting it out, and this is where most of the volume, trading volume, has occurred. Then you can see another area of volume over price right in this area right here, which is right on top of a Fibonacci extension right in this area here, you know, right at about 22 area, roughly, right in that area there. So I don't think we're going to get down in this area, but I do believe it's highly likely that we can end up somewhere in this area resting above the Fib 61 extension right here, near term. I think, you know, as we come through the half of the year, the first half of the year through the end of this month, it's been a great performance by the indexes, but I think the performance of the second half of the year is probably going to be 50% of the performance this year. So, you know, if you know, whatever the return is so far, cut that in half to zero for the second half of the year. Also keep in mind that we're coming into the summer doldrums, so the markets tend to slack off a little bit anyway. The S&P forward earnings, as I said, are at the high end of the range, about 18.8, and with potentially rising interest rates, that's going to put some downward pressure or compression on the PE multiples, which with Q2 coming up here in about another 6 weeks or so, everybody wants to see if earnings of the strong earnings we had in Q1 can continue in Q2, and what is the forward guidance for 3 and 4. I don't think it's going to be at the same pace that we had in Q1 because there was a lot of pent-up demand. So that's going to put a little bit more downward pressure on the markets. I still think the markets are going to finish okay, but it's just not going to be like the performance we had in the first half of the year. Okay, so that's a little bit about where we're sitting here. If I come in and let's take it down to a 2-hour chart, which is a good fractal component of the daily chart. You can see here I've got this upsloping trend line here, and we came down, and over this 2-hour chart on this time frame selected, you can see excuse me, right in that area there. That's kind of where we found our support, and then, you know, the key area is right in here. So these are the key areas where buyers and sellers are really having a tough fight. Okay, and we're seeing up at this level here, you know, selling was winning out, and down here buying was winning out. So we've got this range here that we can be stuck in for a bit. I don't think the markets are going to move too much. The momentum perhaps may take us down a little bit, maybe sideways chop, much like we've been under since the beginning of June. Because if you look here in the at least until the Feds meet this Wednesday, because if you look at the beginning of June, and I'll just, outside of this one move here, which we came down, and then we immediately came right back up and we closed right here. So this is kind of like an anomaly, just a little bit of a little mini flash crash, if you will. But you can see here that we run from about 24, roughly about 24.24, all up to 24.43. Okay, so when you think about it, we've been in about a 20-point range since we first got into the second day of trading in June. We entered June right here at 24.12, okay? Right in this area here with all this buying volume right there. And then we broke out right here. So typically when you have a big breakout of an area like this, and then you come up and then you stabilize, you can be consolidating for a move higher, or you can come back and do a retest. Now that was a retest right there. We may do another retest back down in this area again. I've got an upsloping trend line sitting here like this. So if we close below this flat little mini downward draft here that we made on Friday, then I believe it's going to take us down a little bit lower. So that's kind of what I'm watching in the S&P 500 E-mini futures. Now, the other thing I wanted to show you is look at Nasdaq. It was down 147 points for the day. All right, it actually fell more than it did on May 20th when it was down about 120, 125 points. And we stalked this thing out, and I think a number of our members took the shorts in Q. And you can see this huge downdraft that we had here on this daily chart. And you can just see that it just came all the way down. The opening price is well below us, almost 1,100 points south of where we are right here now. So I don't see it really taking out the 50 EMA. The 50 EMA would be the first sign and line in the sand that we got bigger problems there, right there. If it takes out the 50 EMA, then we're going to come back to this massive area right here of volume over price, and just for lack of a better area, call it 5,400. All right, that's where we're heading. There's not a lot of volume up in this area compared to that big, massive support resistance area right there. I mean, you can see on this daily chart, we entered it in the middle of February, and we finally broke out of it towards the end of April, okay? So we were in it for about 2 months, and then we just had this massive move here. Clearly, we got way ahead of ourselves, and I do believe we're going to be in for a little bit of chop before we figure out that, hey, we want to go higher. So for our members, there's some really good trades we can make in this. We'll talk about those Sunday night for our members. Now, by the same token, if you look at our MACD, there is absolutely zero bearish divergence, zero bet here. So that does tell me that any pullback is probably going to be bought, or at least each pullback is just going to be a way to do some kind of consolidation. So we could be in one of these kind of consolidation modes here. That is provided the 50 EMA holds. If it doesn't hold, this is where we're heading, guys, right around the 5,400 area. All right. And should that break and go down, of course, we're going to trade it. But longer term, I do believe it's going to be a little bit better. But this is what you get when you have stocks like Facebook, Amazon, Apple, Microsoft, and Google accounting for almost 58% of the total year-to-date return of the S&P. And these stocks, by the way, account for 43% of the value of this index here of Nasdaq 100 futures. So when you're trading this, you're trading essentially just about those 4 stocks, those 4 or 5 stocks. So it does not surprise me that we're seeing a little bit of a downdraft like that. Okay. But we also, if we come in and look at this 2-hour chart, you can see how we just sat here right at my resistance level. And I was telling our members here, right in this area here, we were trading, and we had to, I mean, you never know when the downdraft is going to come, right? So, I mean, we were trading some of these moves like this, and then just taking small profits and getting out. And you never know when the move is going to be like that or the move is going to be like that. You never know. But you want to try and be in it, because as it's moving down like this, it's very difficult to jump in short down in this area here. Very difficult. So what you want to be doing is picking a short area here and just deal with the chop until it finally breaks, right? So in looking at this chart, and I had my resistance point plotted up here, and of course we went up just slightly above it, went up to 59.075, so we made all-time highs. And then we literally moved down to 56.68, right? So if you take the 59.07 minus the low point here of 56.68, I mean, that's that is in one day, if you measure high to low, right? That's a big range. That is 239 Nasdaq points. Now we closed right here, so that's where we closed. But we closed, there's the 50 percentile area right there. So we closed, you know, in the lower, let's call it the lower third of the trading range. If I had to divide this into thirds, right, that would be one area. This would be the top third. This would be the second right here, and then this would be the third here. We closed down in the lower third of the range for the day. We can expect some chop here, and then I'm going to look for it to give up some more. And if it does give up more, like I said, I'm coming into the daily, and I want to make sure that the 50 EMA here is sitting at roughly 5,600 holds. If it does not hold, there are a couple of key areas that I'm looking at here. All right, the very next one is the 55.50. These little minor pivot points. This 55.50 was the area that we pulled back when we fell 1.8% on May 20th. That was a couple of Wednesdays ago when the markets, you know, just had that another little, you know, rough down spot, and then it bounced back up again. So that's what we're going to be watching for here. Now, if we look at volatility, you'll see here in volatility, right here, we look at the vol for the day. I mean, the high of the day was 12.16, and you may go, well, hey, that's a big whoop. That's still low vol. But, you know, the market vol for the day actually reached a low in the morning when we were making those all-time highs at 9.37, and then it just shot up. If we go to a 15-minute chart of the day on Friday, this is Friday right here. I mean, it was really a wild day. I mean, if I were to box it in and look at it like that, you know, we started the day down here, and then we got all the way through 12 noon, right around 1 o'clock in the afternoon as we were getting ready to finish off the day. And all of a sudden, all hell broke loose, and the vol just shot straight up like that. It was really not that pretty. And then, of course, it started to mean revert back into this area here. But that just shows you how sensitive the market is to any sign of a downdraft, right? Now that looks like a big move, but in the scheme of things, the vol moved from about 940 all the way up to what, about 1212, you know? So you're looking at a VIX move of 2.72 inside of about 3 or 4 hours, and that's nothing in the scheme of things. If I put it back on the daily chart, it doesn't even register that much. I mean, you can see it, but you know, that just shows you that the markets now are getting very sensitive to any downdraft. In any further downdraft, I think you'll see the vol come up and move into the yellow zone. I've got the price levels in the VIX color-coded, representing different strategies we want to be exploring as the VIX starts moving higher and higher from zone 1, 2, and 3 to zone 4 into black swan, which is, you know, when the VIX gets over 50, which does not happen that often, but it can happen. Okay, so that is kind of what I was looking at in volatility. And then, of course, if we look at the bond market, it finished down just a little bit. We were short bonds, played, you know, a very small profit in bonds right in this area here. Bonds are going to stay range bound until we get through the FOMC. All right, so there's really not much there for our members. We'll be looking at a play in bonds this coming Wednesday. Currencies are going to be moving the same way. You can see the US dollar, as I've said all along, any upward move in the US dollar is going to be sold off. That's the way the chart indicates. We had the 50 cross the 200, and we're in a sell the rally mode. This tends to serve as a resistance point, and if you can see the line right there, it was support right there. It'll be resistance right here, and if we get a move up like that, I'll be interested in shorting the dollar or going long the euro, because the euro is about 58% of the index value of the US dollar. Okay, because if we look at the euro, the chart's just the opposite. Here we got the euro making highs here back on June 2nd, and then we're just kind of pulling back just a little bit in the euro. Okay, the British pound with the UK election, it sold off. Theresa May really messed up. She's about as bad of a politician as I've seen outside of maybe Hillary Clinton, from just the ability to be able to rally people, I guess, regardless of which side of the aisle you're on. But if you look at this, you can see here the pound fell off. Now, I have said all along that the pound is going to be a great trade longer term, but you got to be able to withstand volatility spikes like this. I think the pound going forward is going to be a little bit choppy until we get a clearer picture of whether Theresa May is going to get a ruling coalition in her parliament so that she can enact some of the Brexit stuff that she needs to. Remember, the pound was moving up because, not because they're leaving the European Union, but because it looked like they were going to be able to leave, and it's going to be favorable to everybody in Great Britain. It's the only reason why the pound was moving up. Now with the pound moving lower, I think it could be good in a Machiavellian sort of way with exports, because that just reduces it's like giving a discount on their currency and their products. So let's see how this goes. Longer term, I tend to be more bullish. Gold, on the other hand, gold has hit its Waterloo right up at this level right up here, around 1298, 1299. There is a big resistance area up here sitting at about 1302, 1303. I'm still not convinced this is a bullish time to be bullish gold. You can see we've got an Elliott wave pattern 3, 4, 5. It's not a technically precise pattern, because typically in a 5 leg, I was hoping we'd get up in this area here higher than an Elliott wave 3. But we didn't. We came in almost right at the same level. It's the statistical tie, even though they're just a couple of points apart. You can see the 50 crossing the 200 right there, so I'm going to look at that again as, in this case, the support area. If we break through it, then that's the key pivot right there. I was expecting gold to come down to here when it was moving in this direction, and we fell short by about $5 an ounce, and then we just started this move up. You can see right in this area here that there is a slight, just a slight bearish divergence here, all right? And that slight bed says that we're going to come down in this area here. Now, whether we're buy on the dip or sell the rally, as most Elliott wave 5s, when they finish their print, you get an ABC pattern. So what we need to do is define where these new pivots are going to be with these ABCs to determine, are we going to rally higher, down, or are we going to just stay in a chop mode? So that's kind of where we are with gold right now. I do not see a trade other than just short-term day trading, because it did finish down on Friday 10 points. And that was over the past few days. Gold has moved from about almost 1,300 down to 1271. So it's moved about 30 points to the downside. And then there's our favorite, oil. We're in another trade on oil. We've been trading it successfully now. We're in and out 6 or 7 times profits on each. And you can see I had said oil is probably more likely to come down and test the 2017 low at 43.76. I don't see anything in here in this chart that would change this assessment at this time. We're looking like we're getting ready on Monday and Tuesday to get another cross in the 50 and the 200 to the downside. Remember, these crosses serve as really good resistance and or support points, so that because we're down here, we could get a run up here giving us an Elliott wave 4 print, and then a final run down here, maybe taking out the 2017 lows. And then finally find some support in that area before we do something else. So that's just what I'm watching for in the oil market right now. There are a couple of stocks that, believe it or not, I like in the oil sector. I'll review them Sunday night with our members. About the only other thing that I want to talk about here is if we look at the financial sector and spiders. This is a ratio graph of the finance over the S&P. You can see this big run-up right here. Back here was the Trump bump because it was looked like he was going to put a lot of stimulus out there. The Feds were going to be forced to hike their rates faster. So banks love higher interest rates. So just on the just on the fact that that was going to happen, the financial sector came up in this area here. We finally broke it. Now this isn't a chart of the financial sector. This is just a relative chart of the financial sector over the S&P. And when it's moving down, that means the S&P is outperforming. Well, you can see going back 4 days, the S&P has been the financial sector has outperformed the S&P, and then Friday just took off. So we could get a little bit more upward movement here in the S&P. So if we were to just look at the financial sector alone, XLF, you can see here we took out that key prior pivot here at 2409. Okay, I was quite honestly expecting the financial sector to break the 2017 low. We had a 3, a 4, and I was expecting a 5 right here like that. And we were heading down that way, and then we just never really did break it to get down there. So this is going to negate this wave count pattern right here, and then just say, you can see this volume over price right here, which is sitting right at the opening price of the financial sector for the year, for this year. Now remember, it's up dramatically since the Trump election on November the 8th of 2016, but we had this key breakout right here. So, you know, we're going to probably stay in a choppy range, and then what's going to determine whether we can make new highs is how Yellen conducts her forward guidance with the balance sheet reduction that she's going to probably talk about, and the number of interest rate hikes that she's going to do as well. We will get that out of the press conference. All right, everybody, that's pretty much my update for the weekend. Members, I will see you this coming Sunday night. If you're not a member, I highly encourage you to come in. We're having some successful trades. And our anchor trade is doing very well for us. So we just took that off this past Friday. We'll be putting a brand new one on next week. So come on in and check us out. Otherwise, folks, have a great weekend. And members, I'll see you tomorrow night. Take care, everybody. Ciao.